banks have figured out long ago that they would rather lend money and be a secured lien holder on the property instead of actually owning that property. The banks are earning a rate of return for their investment, and at the same time, the property owner is the one that has all the management and maintenance responsibilities of the property.
This podcast episode is brought to you by Land Caller. Land cold calling designed by land investors for land investors. Go to landcaller.com for more information. Hey there, and welcome to another episode of the Jack Bosch Show, where we talk about all things real estate, finance, and wealth creation. My guest today is Fred Moskowitz, and Fred is a note buyer, a note expert. So we're going to talk about real estate notes, how to create them, how to sell them, how to buy them, how to structure them, anything in the space that we're going to go into some rabbit holes. So Fred, wonderful to see you here today.
Thank you, Jack. It's great to be here.
Wonderful. Great. So let's dive right into it. So what do you do with notes typically, or what do you do in the real estate space?
Yeah, absolutely. My area of focus is as a note investor. And so what we love doing is buying and sourcing and holding notes and building a portfolio, notes that generate cash flow and income, which is quite stable, and that really helps to I find that it helps to round out a portfolio of other types of assets, because notes can generate cash flow right from day one when you purchase and acquire them. And so that's really what I love. And the other benefit is that notes are secured by real estate. They're backed by something with tangible value, and that gives you a unique form of downside protection. And if you think about this, Jack, banks have figured out long ago that they would rather lend money and be a secured lien holder on the property instead of actually owning that property, because this way the banks are earning a rate of return for their investment, and at the same time, the property owner is the one that has all the management and maintenance responsibilities of the property. And of course, they get to have use of it as well. They own it. They enjoy use of it, whether it's to rent out or to occupy it for themselves. And so the lender is in a really good spot because they're secured as a lien holder, and it offers a unique form of downside protection.
Yeah, and that is a key thing that when you buy notes, is like, oh, what if they default? Well, then you can take over the property. But we'll talk about that probably in a second. First thing is I want to go into is I always like to think of like the beginning investor listening here, and there's like, great, I want to get into notes, but that means I have to buy a note, and when I buy a note, I need money for that.
That's right.
How do you do that? Is this strategy only for somebody who already has deep pockets and tries to find a better yield for their money than putting it into the stock market or in their savings account, or are there ways that you can think of that you know of that you can talk to us that somebody could potentially get into the note space without having a whole lot of money on their own side on the sidelines already?
That's a great question. And you're absolutely right. Having capital or access to it is a key element of note investing. You do need money. Note transactions are funded with cash. And so absolutely, if you're buying a note or you're buying a pool of multiple notes, you're paying cash up front for that. Now, where can you get the cash from? There's a lot of ways. You can utilize your own capital that you have. You can utilize retirement account funds. Maybe you have money from an old 401k or sitting in an IRA. That's a great way to fund note purchase. You can also leverage another asset that you have. Maybe you have a property sitting over there that's free and clear, and you can borrow against that. That's a great way to fund note purchases. So in summary, you do need capital, And that's either going to come from yourself or maybe a retirement account or that you have or someone else that you know, or you're leveraging another asset that you already own. And the whole strategy with leveraging an asset is the idea that you're going to earn a higher rate of return on the note you're purchasing, higher than whatever your cost of capital is, especially if you're leveraging or borrowing against another asset. So that
Yeah.
that gives you that arbitrage scenario.
Yeah. So that makes sense. So if you have any of these assets, you can leverage and so on. Could you also, and I think you touched on that, but could you also pool money from investors and then kind of get a piece of the action by doing that?
Yeah, absolutely. And that's a very common model, to pool money from investors. This is what is known as a note fund. And these are set up very much like real estate syndications, where there's a general partner or multiple general partners, and then you have limited partners who are passive investors. And what they do is they will invest their money in exchange for a rate of return, and the fund managers pool that capital together, and then they'll go out to the secondary market and buy notes. Now, the benefit in this is the fund managers are buying at a larger quantity, and they're able to negotiate maybe a better discount on the purchase. And so that helps drive up the rate of return even higher. And so
Yeah.
that's certainly a way for someone that wants to be a passive investor. Maybe they don't want to be involved in the nuts and bolts of owning a note portfolio. And so they're able to leverage the experience and the expertise of the fund managers, also the relationships they have to access and be able to buy notes. And they're going to be in the role of a passive investor or limited partner, receiving return payments every month. So that's a nice cash flow play. And so that's certainly a way for someone to get involved in note investing as a passive investor.
Absolutely. So now that we have moved, get that out of the way, that you can actually, if you have no money, but you know people with money and you have your hustle mode, and you can actually know, and you can put together like a fund or things or something like that. There's ways to get started, or you have an asset that you can leverage. You can get started even though you're sitting there right now thinking like, great, I want to buy notes, but I don't even know where to get the money from. There's many ways to do this. So I always want to kind of like get that excuse out of the way. But Jack, that requires money to make money. Well, no, it requires creativity and a network to make money. And
Yeah,
neither one of those costs you money.
Yeah,
Right?
you can either have the money or have access to money in whatever form that is. Yeah, it's
Exactly
very
right.
powerful.
So that's just like one of my pet peeves, that people always say like, well, it takes money to make money. And it's like, no, BS. It doesn't. It takes relationships, which you can do by investing time in people and meet people with money, and then it takes creativity. And of course, it takes also a backbone and doing what you say you would do and becoming a reliable partner to people. So with that said, let's go into the actual thing. So what strategy do you use? Do you simply use your own money? If yes, how did you make money to invest in notes? Or how did your journey kind of go from seeing this to learning this to understanding this to doing your first notes to now doing what you do? How much volume of notes do you do as a matter of fact?
Yeah, we're buying notes pretty much every month on the secondary market. Now, I've used now these different techniques. I've used all of them over the years, using my own money. I've leveraged other assets that I've had. I've used retirement account funds. I have raised capital from investors that wanted to be passive, and I've done all of those methods. They all work, and it really comes down to your level of experience and your timing and what you're comfortable with. But in general, I feel like a great place to start is being involved as a real estate investor, build up some assets and a portfolio there. And then once you have some equity built up, now you have something you can work with. You can leverage, or you can even sell a property and buy notes. I know of many investors that they've had a few properties, owned them for many, many years. And they said, you know what? I'm at a certain point in my life where I want to simplify things. They sold a couple of properties off that had a lot of equity in it, and then they redeployed that into notes. And the benefit from doing that, Jack, as you know, when you have a lot of equity in a property, it's generating no return for you at all, right? It's like you have that sitting there kind of trapped. And so selling the property, yes, you take a tax hit when you do that, but then you can go turn right around and redeploy that into notes. Now your rate of return goes way up, because if you think about it, you're putting the full power of that cash, of that equity, into generation of a higher rate of return. And so it's a great way to go. I've met countless investors that have taken that approach, and it's worked out really well for them.
That's interesting. So, how can you lay out the steps on how to do that? What would be step 1, step 2, step 3?
Sure. I talk a lot about this in my book that I wrote about mortgage note investing. Now, it's very simple. You have properties, you have real estate, you've built up equity over time. Maybe you've done renovations, or you had it set up as a rental property over many years. Let's say 10 years is a good time frame. Then after that, you can either sell the property and cash it out, or maybe refinance it, pull cash out that way if you want to still continue to own the asset. And then you can turn around and deploy that into notes. You can buy, what I like to recommend is buy multiple notes with your capital, so that you're spreading your money out into deals.
Correct me if I'm wrong. I heard you say, though, that you prefer people refinance their places and not sell them, because when you sell them, you have to pay capital gains and so on and so forth. When you refinance them, you simply get tax-free money out. Might not be as much, because usually don't give you 100% refi, but you get to keep the asset, it appreciates, and now you get to keep the difference on there.
Correct.
Yeah,
it's a great strategy. It just depends on each person's individual goals.
Yeah, so
which way to go, but it's a great option.
Yeah, no, then that makes sense. And that obviously there the steps are clear. You go to your bank and you say, like, hey, I got equity. Can I get a line of credit on it? Or do you prefer lines of credits, or you prefer simply a fixed rate second mortgage or something, or second lien on your, let's say, house or whatever asset it is? If there's a lien on it, or just if there's no lien on it, bottom line of credit or a fixed rate kind of loan?
Well, yeah, the line of credit, I like those, because you don't have to pay interest on that money until you actually utilize it. That's the benefit there. So you can either, it might take you a few months, and then you're ready and you deploy that into a deal. Now you're only paying for interest on that money once you actually draw from the line, as opposed to if you just refinance and pull cash out, then that's it. You're starting to pay interest. So you do have a little more flexibility with using a line of credit.
But your interest rate is usually higher.
Your interest rate may be higher. It's going to be variable as well. Yeah. And so you have to be comfortable with that. But the benefit there is, let's say you did a note deal, bought some notes, maybe you sell them later, made some profit, and now you put that money, pay the line down, right? Pay it back down, and now you're ready to go for your next one, and your loan balance is back down to zero. Yeah. So it's just a flexibility.
That's something for the audience, I want to make sure people understand. People are always, sometimes I have this conversation with people, say, like, when I go deeper into a financial conversation with people, they're like, well, isn't a fixed rate better if I get a fixed rate at, let's say, even in this market, sometimes if you find a bank willing to do it, there's some new banks. I'm on the board of advisors of a new bank that they're very eager to get loans, and they're just when interest rates were 6.5%, they gave me a 4.5, 4.75, or 4.5% interest rate on a loan because they needed to get loans out. So sometimes that happens. So bottom line, let's say you get a fixed rate of 5%, and as interest rates are coming down again, perhaps that's something reasonable, something that can be accomplished soon again. But if you have a floating line, that might be a 7, 8, 9%. People immediately say like, well, I'm going to go for the fixed rate. And as you said, what I want to point out that hopefully everyone heard is that, yes, 5 is better than 8 on a floating rate. But if you're 5, you have to pay every single month. You 8, if you only paid for 6 months, you technically only paid 4% for the year. Because if your money's only out for half of the year and then it's back and you pay 0, then there's nothing you pay for the other half because your money has been, your line has been paid off. So take that into consideration as to your expectation. If your expectation is to have the money out 11 and a half months, then a fixed rate is probably better. If your expectation is that you're going to buy a note and then it's a short-term note and you pull your money back and it might take you 2-3 months to find the next note and it's a short-term note and you get a bit, or you're funding some fix and flippers or something like that with a note, then it's, in that case, you might be better off with a line of credit, because in between it's down to 0 and you pay nothing. You only pay when the money is producing, not all the time.
Yeah. Yeah, that's a good point, Jack. And part of the equation is what's available to you at the time you're procuring the lending, right? Like you said, if the bank has an appetite to originate fixed rate loans and they're offering a great rate, well, maybe it's worth your while to consider that. So yeah, there's a lot of factors that go into it. That help you with that decision.
So what kind of typical notes do you like to buy? What do you think? What's the safest note to buy for somebody who says that's something I want to get into?
Yeah, that's a great question. So for someone starting out, obviously safer low risk notes, I like that. Now they're going to pay a lower rate of return because, like any other investment, the more risk you're willing to take on, you're going to be compensated for that with a higher return. So what does a safer note look like? Well, it's going to be on a residential property in a good market, not a rural market, or a place where people want to live, that has a reasonable days on market for homes listed for sale, and there's some demand there in the area. And so you look at that, you look at the local real estate market. What does the property look like? Property values. Is there a good equity coverage backing the note? Which that's certainly a factor. And then going beyond that, you would look at the borrower. What's their credit history? What's their employment? Do they have stable employment history? What is their record on payments on the note? Are all payments on time like clockwork for the past 5 years? So that tells you a lot. And when we're looking at notes as investors, we're going to see all these different scenarios. Things don't always line up exactly, and you may see, oh, there's some more risk on this one note because of the real estate market, or maybe the equity position is not good, or maybe the borrower is involved in some kind of seasonal work where during 6 months of the year they're super busy making a lot of money, and then they have a part of the year maybe in the middle of the winter where there's very little work, and maybe you'll see they get behind on their payments, but they always get caught back up, and it's a cyclical pattern that you see every year. And so you'll see some different things. This is all part of the due diligence process that I talk about and teach about, and you will take that into account. But for a safe note, you want to have good equity coverage, good payment history, and a good credit and background for the borrowers.
So you're talking about, if I heard you right, you said that the best notes to get started with are potentially a house note, right? A house note in in a decent market, so not in a little village with 12 houses where it's a crap shot on whether ever anyone will want to move there and buy a house, but in a city that's kind of stable and growing, and where there's like the likelihood that if something goes wrong, that's really behind it. If
Yeah.
something goes wrong and you have to buy that, you have to foreclose on that note, you can turn around and in a reasonable time period sell that house again and recover your money. That's really
Yeah.
it. Like, if you need to start thinking, what I'm hearing you really say between the lines is like, you need to start thinking like a bank. And what I learned dealing with banks is that banks are not even in the business of maximizing their dollar. They're in the business of making sure the default rate is minimized.
Yeah.
Right? If they rather be more conservative and low, and say no to a loan than have a chance of losing money on a deal. Because if they consistently make a little money on all those deals, they make combined a lot of money. Is that about
Correct.
right?
Yeah, that's exactly right.
Yeah.
That's the power of leverage.
Right.
Yeah, banks know how to stay in a good position of being protected on whenever they're doing loans. And
Yeah.
so we see that. We see this is why banks usually will require a borrower to have escrow so that taxes get paid, insurance get paid, because as a lender, those can be threats to the lien. If taxes aren't paid, that's going to jump up in front of priority of any mortgage. And so the bank is going to protect their interest by making sure there's an escrow account set up and the taxes are paid on time every year. They're going to collect the money from the borrower and pay the taxes on their behalf.
Yeah, exactly right. And now the next question comes up again. Let's say a beginning investor is listening here is like, a house note. Why would I ever be able to buy a house note? Aren't those notes all held by banks?
Yeah, this is a great question. Banks usually are the originators of
I'm,
those
by the way, I'm
notes.
playing a little bit like
Yeah.
beginner investor here. So I'm asking you some of these questions, and because obviously our listeners can't ask those questions, and many know the answer, but still, if you're somebody's like brand new, it's like notes. How do I buy a house notes? It's like, how's that? When would somebody be able to buy a house note?
Yeah.
Yeah.
Yeah. So banks constantly are creating notes, they're originating mortgages, and then within a few months, they sell them on the secondary market. Why do they do that? And we see this all the time. Just about everyone out there listening has experiences where you go, maybe you buy a property, you refinance a property, you go to closing, sign all the loan documents, and then when you know, within like 3 or 4 months, you get that letter from the bank saying, "Dear Mr. and Mrs. Homeowner, we're writing to inform you that your loan is being sold, and here's the contact information of the new lender. And starting next month, please send your payments to the new lender. And by the way, don't worry, none of the terms of your loan are changed because it's a contract. Interest rate's the same, your payment amount's the same, everything stays the same. So don't worry. And if you have any questions, you can call us. However, please send next month's payment to the new lender." Right? That happens all the time. And so this is the secondary market at work. The bank likely sold your loan at a discount to the new lender. The bank now recapitalizes, they get their money, and then they'll turn right around the very next day and originate a new loan for someone else. And the bank makes their money from the points and the fees and all the application stuff that they do. They do a really high volume, low margin business on that, but that's how they operate. Then on the secondary market, different institutions like uh, note funds, hedge funds, maybe a bond is structured where they're buying all these notes and aggregating them into a bond. And after a number of years, the time duration for that bond has expired, and now that gets broken down, and again, all the notes get sold off again. And so there's always these opportunities for individual investors to tap into the secondary market and buy notes. It's not just for banks and the big Wall Street institutions. There's also space for individual investors, smaller note funds, hedge funds. These are a lot of the participants in the secondary market.
Yeah, wonderful. Yeah. Do you also buy notes that were created like with people whose credit is not so good, who perhaps had to go outside of the banking market, and where there's like basically not optimal terms, but perhaps they put down a bigger down payment and things like that? Is that notes that you're looking at, or the completely alternative market of the land notes where which are completely unbankable? Like to your point, the banks are in the business of restricting the risk, and so banks don't even lend on land. So you want to do a land note, great. We do lots of land notes. I personally don't sell my notes. I like the cash flow from them, but a lot of the people that we teach go sell the notes, and there's an active market for that. But are you in that market, or in that? How does that market look? How do you look at that market where it's like either a house loan that completely happened outside of the banking world, or a land loan that also happens outside of the banking world?
Yeah, this is a great question, Jack, and absolutely, loans like that exist. I have colleagues that specialize in that. They specialize in what's called owner financing notes, where the property seller was the originator of the note, and they created it, maybe they held it for a while, and then sell it. And so in fact, that's a niche area that people specialize in. And so we see that. Land notes is another. I know some investors love land notes, and there's others that they don't like them and they'll stay away from them. And there's a place for every investor in this space. And it comes down to what you're comfortable with, your risk tolerance, and your experience level.
Yeah. Do you act in that market too?
Yeah, I mean, we look at different notes all the time. Sometimes we see commercial deals on larger properties. There's just so many different areas and avenues out there. And
if you buy a note like that, let's talk about the discounts on those notes. How does the discounts, if you can even speak, like generally speaking, like a bank generated note with all the stat stack of paperwork and things like that, versus a seller financing generated note, how do the yields or the discounts compare in the two of them?
Yeah, there's no typical at all, Jack. It really varies. A lot of it has to do with timing. For an investor, a note holder that needs to raise capital quickly, they're going to be more flexible on discount, as opposed to someone else that says, hey, I want to sell this note, and if it takes me a year to find the right buyer, I don't want to give a big discount, and I'm happy to keep collecting the payments every month while I wait. And so you have those two extremes, right? I've bought notes where the seller, they needed capital quickly because they're funding another deal.
So with that said, let's bring it back to the average Joe out there or Jane out there wanting to buy a note. So what typically, as a very brand new beginner, what is, like, from your experience, a yield that somebody should looking for? And how do you even define yield? What is the world yield? It's basically the percent the return that you get on the money invested is your yield. But what is a yield that a typical land note buyer, doesn't mean land, houses, whatever thing. What is a typical yield that a note buyer is looking for? Or is there certain thresholds per category?
Yeah, I would say on a residential note, you're going to see between 6 and 8%, maybe 9, on a note that's in first position. If you're willing to go to notes that are in second position, it can go higher, 9, 10, 11, 12%. So that's what I see out in the
Yeah.
marketplace.
And that's on
And
houses, right?
yeah, this is for residential houses.
Residential houses,
And
yeah.
so if you're willing to do commercial loans, then yeah, they can be much higher, but more complicated as well. And you have to be comfortable with analyzing that type of collateral because it's a lot more complex than a single family house, for instance.
And on land, what do you typically see there? Is there anything, do you have any visibility into that space?
I don't I don't look at land notes too
That's okay.
much. I know, yeah, they're out there, but I think that's going to really depend on the potential use and potential income for that property. That's going to come into play
So I
with it.
can perhaps fill in on that. Typically in the land side, what I see on the market is a note buyer wants at least a 12 to 15% yield, and then they're happy. And now the second parameter is what's the loan to value that you typically look, and I can fill it in for the land again. But what it typically loan to value that you see that is that you want on a note in again in a good market, in a stable market with some sales records and things like that. When not
Yeah.
like a little house in the prairie that you don't know if you're ever going to sell it again.
Yeah. Yeah, on residential loans, I would say loan to value between 50 and 80% is most common that you're going
Okay.
to see. Sometimes more, sometimes less, but that's what's most commonly out there.
Okay. Good. Commercial. Where would you put that on?
Commercial, they're going to be lower loan to values. Typically, you're going to see um, 70, 60% or less.
Okay.
And again, it depends on what's the income profile of the property and how is that property supporting the debt service.
Then before I fill in for the land, I have one extra question, and that is how much of an importance is the amount of down payment in your world? It plays obviously a role in the loan to value, but particularly in the non-institutional world, or if somebody is like values have gone up and things like that.
Yeah.
Let's say if somebody buys a $300,000 house and they put only 5% down, and then just it happens that the values in the area go up by 30%, and now it's a $400,000 house. Obviously, the loan to value fits, but they still only put $3,000, or they still only put whatever $10,000 or something like that down, or $20,000 down. Does that play into your role, into your decision on whether or not to buy the note? Or is it strictly loan to value?
Yeah, it's definitely a consideration to look at. And really, that is going to give you a sense of how much skin in the game does a borrower have? What's the likelihood that they may walk away from the property and hand the keys over? I mean, that's certainly a possibility that can happen. And a borrower that didn't put a lot of money down, they're going to be a lot more open to doing that than someone that put a lot of money down. They're not going to walk away that easily. And so that there is a consideration there. However, also it depends on how long ago was the loan put into place.
Right.
Because if it was recent, let's say in the last 12 months, then it matters a lot more than if the loan was taken out 10 years ago.
Yeah. Perfect. Because if I fill in the land side now, it's the same thing. Like typically the loan to values in the land area need to be below 80%. More like banks actually put that line at 50% if they even give you a loan. I have no problem giving somebody a 90% loan to purchase price. But if the purchase price is, let's say if this property is worth $100,000 and I can sell it for $80,000 to them and they give me $10,000 down, then that is like whatever, like 14% down payment and a 86% or so loan to purchase price. But at that level, it's only it's a 72% loan to value, because they basically they're owing the property is still worth 100. Their loan is $72,000, and from a loan to value, that is I'm okay with that. From a down payment point of view, that's kind of like what I want to see in one of these deals or more, because I can tell from experience, from having done 5,000 land deals and probably a couple of thousand of them are seller financing deals, that in the land space, it is crucial how much they put down, because a lot of these loans are not reported to their credit bureaus. So they don't affect their credit. They're private loans, seller financing loans. So while they might have good credit and so on, if they put down $500 on a loan, the likelihood of them walking away is substantial. Like if it's the $50,000 loan, $50,000 property, and you let them buy it with $500 down, there's a 20% chance they walk away from that thing. And that's a huge risk. So the moment though they put down 10 grand on a deal like that, that chance goes down to like 1% of them walking away. And so the amount of down payment is something we very closely look at in the land space. But of course, exactly what you said, we combine that with the length of it. If that happened 5 years ago and they made every single payment on time, then it doesn't matter much anymore, because their payment history has overwritten everything else, and they've shown to be a really solid payer. And on top of it, now they've paid so much more that they have skin in the game and so on. So I just was curious to see if that plays a role in the more traditional notes, because in land, the down payment plays a big role. You want to see how much they put down, how much skin they have in the game, because that's one of the most driving factors on the quality of that note.
Yeah, that's wonderful. There's a lot of factors, and as you can imagine, it can get complex to evaluate each of these different parameters, and sometimes things will conflict with each other. But in the end, it comes down to your risk tolerance as an investor. What are you comfortable with? And if the worst case scenario happened, are you okay with that? Are you still going to be able to come out whole and recoup your investment and move forward?
Yeah. And that's why, for example, a lot of our investment, a lot of our people that they go through our coaching programs and then become successful land flippers, they actually, with the money that they make, they become note buyers then, because they're very comfortable in the land space. They know if it defaults, well, they already know what to do anyway. They know how to resell it and so on. And sometimes they even go into engage with if they sell their notes, they do agreements with the note buyers that if the borrower defaults, they're going to go help that note buyer resell the property again in order to secure their rights. And because not every note buyer is a professional real estate investor and knows how to actually sell their underlying real estate afterwards again.
That's exactly right. Not every note buyer is in a position to handle that, or maybe they just don't want to because they're focused on other things in their life or other businesses or other areas. And so this is part of the whole equation about how do you want to be involved in the note industry. For some people, being a passive investor is a great option because they're focused on their career or they're focused on another business and they don't have a lot of time. They would rather be a passive investor in a fund, and they don't have to be directly involved. And then another investor, they may have a lot of time and be very interested to get hands-on and get into different aspects of each deal. And that's great too. You can do really well with it. And there's no right or wrong answer. It's a very personal question and decision-making process. And what's interesting, Jack, is I've spoken with so many investors. I see people start out as passive investors then they get comfortable, they like the business, and after a few years, they start dipping into the waters of being active and hands-on with notes. And I've also seen the inverse of that. Someone started out as active and maybe they got to a point in life where they said, hey, I want to simplify things for myself. I want to slow things down. Maybe they're a little older or approaching retirement, and then they pursue more passive investment opportunities, and that works for them as well. And so
Yeah.
it's always something we all evolve and grow and change throughout our investment journey over time, right?
Yeah. So what is a yield that you're looking for? What is like a return that you're target for your personal investments? What are the numbers you're looking for to get?
It really varies. I'm buying notes constantly. Part of it comes down to what's the cost of capital and will it work for this deal? And so in some instances, we can be good with a 7 or 8 or 9% return. And then there's other instances where, hey, for this to work, this needs to be a 12 or 14% rate of return. And yes, we can take more risk on it, but the cost of capital implies that we have to go for a higher rate of return. But overall, then it all ends up averaging together across a larger portfolio.
Right. So, have you dealt with? We're running out of time a little bit right now, so we might have to have you come back for a second session here. But have you dealt with non-performing notes in any shape or form? Are you into that space?
Well, non-performing notes, I'll tell you, it's that's an interesting aspect of the business. But right now, the way the real estate market is, there's not too many non-performing notes. They're just not out there. Here's why, because if a borrower gets in trouble and defaults on a loan, it's very easy for them to just list the property for sale. There's high demand, it will get sold, and they mostly have equity. So there's no issue. It becomes very easy for borrowers to get out from under a note if there's a default scenario. And so we really are not seeing too much non-performing notes even available. But yeah, that is a business that's out there, and some people
And
focus
that's
on that, but it's just not much activity right now.
okay. And you know what? That's actually very good to hear, because that means that even if people are in trouble as we're entering a recession or not, or whatever this economic world is that we're living right now, that there's not a whole bunch of hardship is being created by properties being going into foreclosures, and people's life being financially ruined over it, because in the current market they can sell with a profit, they can walk away with some cash in their pocket, they can move on, they can fix their life. And that's actually an overall positive thing.
Yeah, absolutely, Jack. And I think that a lot of lessons were learned from the financial crisis of 2008, 2009. A lot of government programs got put into place for borrower assistance and counseling and help and support. So there's a lot of
And better
resources
underwriting.
available. Yeah, there's a lot of resources available that weren't in the past. And so there's solutions for just about every problem.
Wonderful. Great. Well, with that said, I heard you say that you have written a book and that you teach this. So how do people learn more about this if they want to get started in that space? How do they contact you? How does that work?
Yeah, thank you, Jack. I appreciate that. The book I have is called The Little Green Book of Note Investing. You can buy it right on Amazon. It's available there. And for anyone that would like to connect with me, you can visit my website, which is fredmoskowitz.com. And if you prefer a little bit of an easier spelling, you can go to giftfromfred.com. It'll take you right to my website. And once you're there, you can connect with me. You can request a special report I have that I can send out about note investing. And whether you want to learn about passive investing, active investing, there's a lot of avenues. And I always love speaking with investors and building relationships, because that's a big part of what we do, is building relationships. You mentioned that in the beginning of our conversation, and I wanted to end by emphasizing the importance of that. because as an investor in general, no matter what you do, the relationships that you have, that you nurture, that's what really matters.
Yeah. At the end of the day, we're living in an AI world. We're living in an online world. We're doing this interview via Zoom, everything is like, but you know what? At the end of the day, real estate and really any business at the end of the day is a relationship business. So it's you make the best relationships when you can look into each other's eyes, when you can over drink in the evening, over dinner, when you can really feel out the other person, know the other person, like make sure you know that this is somebody that you can work with, and I 100% agree with that. So build those relationships. Go join RIAs. Go to local meetups. Go to real estate conferences. Go and enter coaching. Get out of the house. Meet other people, and you'll be surprised if you tell them what you do that they're interested in that. We have lots of people that we know that once they understand what we do, they're like, well, can I give you money? And well, usually the answer is no, but in some cases, when we have like a project in the multifamily side of things, the answer might be yes. And
Yeah.
and so you'll be surprised of just how quickly you'll be able to build up a funding base, even if you start without a lot of the funding. But the key is get the knowledge first. So gift from Fred. FredMoskowitz.com. Go check it out. And thank you very much, Fred, for being with us.
Thank you, Jack. Thank you for having me on today.
All right. And with that said, that's a wrap. So guys, as always, give us that 5-star review on iTunes. Please do it right now. Otherwise you forget. If you're watching on YouTube, go give us a thumbs up, subscribe, hit that notification button, share it with your friends so we can reach more people with this knowledge about how to create wealth through real estate. All right. Thank you very much. Bye-bye.